Imagine waking up to find your country's biggest bank frozen. Not by hackers, not by collapse, but by a foreign government 8,000 miles away. That's not fiction. That's the warning global banks just got from the US Treasury. If you touch China's trades or oil tied to Iran, even if it's paid for in Chinese yuan, you could lose access to the entire US financial system. But here's the twist. The more Washington tightens control, the faster the world starts building a system without it. And the next move, it's already in play. In April 2025, U.S. Treasury officials met behind closed doors in Hong Kong, not to negotiate, but to issue what experts are calling one of the most aggressive financial ultimatums in decades. According to Bloomberg, and CNBC Washington warned global banks, if you handle oil linked to Iran, especially when that oil ends up in China, you may be cut off from the U.S. financial system entirely. That includes access to swift U.S. dollar clearing and all U.S.-based intermediaries. This wasn't an empty threat. Within 2 weeks, 9 Hong Kong-based entities were sanctioned for allegedly laundering oil revenues through falsified shipping documents tied to Iran's Revolutionary Guard. But here's where it turns strategic. China currently imports over 1 million barrels of Iranian oil per day, accounting for 91% of Tehran's exports. And most of it is paid for in Chinese yuan, not dollars. The U.S. isn't just targeting oil. It's trying to collapse a non-dollar trade loop that's rapidly expanding. And the risk. The more aggressively Washington uses financial blackmail, the more it invites a countermove, a global exit from the dollar itself. Hong Kong banks are now caught in the crosshairs of 2 financial superpowers. The Wall Street Journal confirmed that Treasury officials told institutions like HSBC and Bank of China Hong Kong to look beyond front companies and identify the ultimate beneficial owners involved in Iranian oil trades, particularly those transacting in renminbi or other non-dollar currencies. These institutions aren't minor players. As of Q1 2025, Hong Kong handled over $260 billion in cross-border settlements, with 54.3% now conducted in yuan, surpassing the dollar for the first time, according to China's FX regulator. What's unprecedented is the extraterritorial nature of the demand. The U.S. is effectively telling foreign banks operating outside U.S. jurisdiction to act as compliance arms of the U.S. Treasury. Experts like Max Meislish at FDD warn that unless these banks are officially designated and licensed for enforcement, Washington is blurring the line between regulation and coercion. So what happens if these banks push back, or worse, align with Beijing's alternative financial networks? The strategic value of Iran's oil to China goes far beyond barrels per day. Under the 2021 China-Iran Cooperation Agreement, Beijing secured discounts of 12% below market, plus a risk premium of 6 to 8% locked in through long-term supply guarantees and denominated entirely in renminbi. That's not just an energy deal, it's a direct challenge to dollar hegemony. According to Rapidan Energy Group CEO Scott Modell, Trump's sanction threats are clearly aimed at pressuring China's state-owned firms and infrastructure. But here's the paradox. Every new sanction Washington deploys to block UN oil trade only pushes Beijing to double down. In March 2025, China's renminbi-based cross-border transactions hit $725 billion, up 22% year-over-year. Bloomberg data shows the UN now accounts for 4.13% of global payment value, its highest on record. This isn't just a workaround, it's a prototype. And as the U.S. squeezes harder, it may be accelerating a self-fulfilling prophecy, a post-dollar oil economy. Imagine you're a foreign manufacturer considering a U.S. expansion. You're sold on the idea of America's unmatched consumer base. But then the numbers hit. As of April 2025, U.S. consumer sentiment has dropped to its second lowest level since the index began. The University of Michigan's latest report shows 12-month inflation expectations hitting 5.6%, a high not seen since 1981. Retail and wholesale profit margins contracted 1.6% in April alone, the sharpest decline in over a decade according to the Census Bureau. Companies aren't passing costs on to consumers, they're absorbing them. And that's before tariffs. According to Commerce Department, data steel import prices are up 25% year over year. Bloomberg reports that since 2023, retail profits have declined in 15 of 17 months. This isn't a market poised for growth, it's an economy running out of slack. So if the entire case for reshoring rests on a strong U.S. consumer, what happens when that pillar collapses under its own weight? President Trump's so-called One Big Beautiful Bill promised permanence for the 2017 tax cuts, but buried inside is a clause with potentially massive global consequences. If passed, it would authorize retaliatory taxation against any foreign country that imposes unfair tax treatment on U.S. firms. But fairness isn't legally defined, and enforcement discretion lies entirely with the White House. The proposed penalties, a 5 percentage point increase in taxes on U.S.-sourced income of foreign companies, and a jump in withholding tax from 10% to 12.5% on outbound payments figures, confirmed by the Congressional Budget Office. According to a May 2025 analysis by the Tax Foundation, these hikes could reduce foreign direct investment into the U.S. by up to $91 billion annually. Even more contradictory, this provision may torpedo the very reshoring plan it aims to support. Higher taxation, unpredictable policy swings, and retaliatory trade risks create precisely the uncertainty manufacturers fear most. Besson's testimony to Congress insisted the bill would stabilize deficit to GDP ratios. Yet early scoring from the Joint Committee on Taxation shows rising deficits in multiple income brackets. So the bill intended to make America a magnet for investment may in effect become a repellent. On paper, secondary sanctions are a scalpel, precise, targeted. But in practice, they're more like dynamite. According to the U.S. Treasury, foreign institutions facilitating sanctioned trades, especially Iran-China oil payments routed through UN risk, losing access to dollar clearing. But this threat is accelerating the very trend Washington hopes to suppress. The People's Bank of China reports cross-border transactions hit $724.9 billion in March 2025, accounting for 54.3% of China's global trade, up from just 36% in 2022. SWIFT data now ranks the yuan as the fourth most used global currency, with a 4.13% share in payment value, a record high. Beijing's policy shift isn't just economic, it's strategic. In April, the central bank launched incentives for state-owned enterprises to settle foreign contracts exclusively in yuan. As Reuters reported, China's deputy PBOC Governor Liu Lei called the multilateral trading system blocked and warned that tariff walls were disrupting the international economic cycle. The irony, every sanction meant to isolate Iran, or China is giving nations a blueprint to isolate the US dollar instead. But if the world stops defaulting to dollars, what replaces it? Imagine you're the CFO of a Japanese auto giant. Your profits are up until you convert them back to yen. In 2025 alone, the US dollar has fallen 8.1% against the yen, wiping out margins for firms exporting from American factories. At the same time, the U.S. is proposing a 5-point corporate tax hike on foreign firms, through the One Big Beautiful Bill, plus new withholding taxes on outbound payments. According to the Tax Foundation, this could reduce foreign direct investment to the U.S. by $91 billion annually. Meanwhile, the U.S. labor market isn't offsetting the risk. April data from the Bureau of Labor Statistics shows manufacturing job growth stalled and inflation-adjusted wages declined 0.3% quarter over quarter, compounded by regulatory volatility, tariffs jumping from 10% to 30% within months, then suspended, and reimposed. Foreign firms now face a moving target. Even established players are retreating. Bloomberg reports 246 major U.S. companies have filed for bankruptcy year-to-date, the highest in 15 years. The more Washington tries to control global capital flows, the more global capital looks elsewhere. Trump's trade strategy relies on pressure, but pressure without consistency becomes volatility. Since January 2025, tariffs on Chinese imports have swung from 10% to 30%. And now analysts expect them to hold until at least late 2025, according to a Bloomberg survey of 22 global fund managers. The result, Chinese exports to the U.S. have dropped sharply, and official April data shows China's industrial output grew just 5.9%, down from 7.7% in March. Yet the unpredictable nature of these measures is arguably more damaging than their size. Sam Jochum, economist at EFG Asset Management, warns that Trump's first term should serve as a warning. Agreements are not guaranteed to hold. Businesses aren't just pricing in tariffs, they're pricing in chaos. Retailers rushed inventory before the hikes, inflating costs. Manufacturers froze investment plans, unsure which rulebook they'd be held to in 6 months. Even the day tariff truce announced in May is viewed with skepticism. The deeper problem isn't confrontation, it's confusion, and no one's investing billions into confusion. Sanctioning oil is one thing. Sanctioning entire banking systems is another. In May, the U.S. formally blacklisted 9 Hong Kong-based non-bank entities for allegedly obscuring Iranian oil origins, according to the Treasury Department. But the pressure didn't stop there. Officials met with major banks in Singapore, Malaysia, and Hong Kong to demand they investigate non-dollar transactions tied to Iranian oil flows, often routed through shell firms linked to Chinese buyers. Max Maeslish of the Foundation for Defensive Democracies argues that no action would be stronger than actually designating the banks responsible, but warns that doing so could trigger systemic backlash. Hong Kong banks, many with branches in Europe, and the U.S. risk losing their access to dollar-based global settlement networks. Meanwhile, China continues building financial insulation. In April, it expanded pilot programs for central bank digital currency (CBDC) usage in trade with Southeast Asia, sidestepping dollar intermediaries altogether. By weaponizing access to the dollar system, Washington may be teaching the world how to build without it, and that shift, it's already begun. Washington's dollar-based dominance was never just about money. It was about trust. But what happens when allies, trade partners, and global banks no longer trust that access will be stable, legal, or reciprocal? The more America weaponizes financial privilege, the faster the world starts asking whether that privilege is still worth the cost. China isn't fighting back with tanks. It's using spreadsheets, oil contracts, and payment rails. And it's finding willing partners. But here's the real cliffhanger. If the global banking system fractures under the weight of sanctions, tariffs, and uncertainty, what replaces it? Who gets to set the rules next time? And will the next global reserve currency be backed by economics or politics? Let us know. In the comments, has the U.S. strategy gone too far? Or is this the only way to hold leverage in an unstable world?